Investors Chronicle.
Welcome to another episode of the IC Interviews podcast. We're joined today by Maggie Fanari, who since last year has been Chief Executive of Rothschild Capital Management, which runs the RIT Capital Partners Investment Trust. Maggie was previously Head of High Conviction Equities at the Ontario Teachers' Pension Plan, but today, of course, we'll be talking about RIT Capital, about the Trust's asset allocation, the discount to NAV on which it trades, and the outlook for global markets of all stripes. Maggie, welcome to the show.
Great. Thank you, Dan. I'm delighted to be here.
It's great to have you. Let's kick things off straight away and start by talking about the structure of the trust, which will shortly bring us to the discount that I think has caused some angst among shareholders. RIT is rather uniquely structured, split largely across three buckets: private assets, listed equities, and so-called uncorrelated assets. The presence of the latter in particular means you have tended to get grouped as a wealth preservation trust, quote unquote, i.e. something which acts as a diversifier to other holdings. Equally, the presence of the listed and unlisted private assets means there are plenty of growth assets in the portfolio too. So do you think the trust's reputation as a partial wealth diversifier, partial growth trust is justified? Do you think people have a good sense of what the trust is? Or how would you describe what the portfolio offers in short?
Great. Thank you. I mean, at the essence of it, what we're looking to do is compound growth for our shareholders, taking less risk than equity markets. And that's specifically what we've been able to do since inception. We've grown our net asset value, or compounded that for shareholders, at 10.4%, and our share price has followed a similar suit. And the way that we've been able to do that is by building a diversified and resilient portfolio. So we'll invest in many different geographies, so we don't have concentration risk. We will invest in quoted equities. We'll invest in private funds to capture growth. And then there is a portion of our balance sheet, of our net asset value, where we invest in uncorrelated strategies, so hedge funds and real assets, to give us that steady stream of returns over a cycle. So when you put all of that together, it becomes an excellent addition to a more traditional 60-40 portfolio, because it's quite complementary from that perspective, a differentiated source of returns for anyone's portfolio.
Well, we'll discuss each of the parts of the portfolio in turn, but why don't we start by talking about, following on from that perception question, the question of the discount, which has been persistent now for a few years. You've addressed some of these concerns, it seems to me, in terms of the private assets, which I think it's fair to say is what has been concerning some people, or it's certainly perceived to have been concerning some people, because ever since interest rates rose, we've had questions over valuations of all private assets and whether those are accurate and how people can accurately value them as an outsider. You still have a big bucket of private assets in there, which we'll get to. You're doing buybacks as well in an attempt to narrow the discount. So far, though, it's been fairly persistent, as I say. What's the strategy there for improving that? Because I should say as well, returns have been, as you said, good. The private assets, the realizations you've had appear quite strong, and yet the discount persists. So what's your thinking about what you can do to try and improve that situation?
So if we think about the discounts, both for RIT, they're also persistent across the sector, across the investment trust sector, and that's created real value within the sector as well. And it is a top priority for both the management team and clearly our board as well. And the way we've looked to address the discount is performance, so delivering strong and consistent NAV growth. We've done a very large buyback program, so we've bought back more than 10% of our market cap over the last couple of years. That's both very accretive for our shareholders, but it also shows our confidence in the portfolio, which has delivered particularly on the private assets, as we've seen this year. And it also a combination of enhanced engagement with our shareholders and also providing increased transparency. More recently, the sector hasn't performed as strongly, and the market does reward performance. So we believe through that consistency in the approach that we're doing, that will lead to creating shareholder value over time.
Yes, you're right. I should say, I mean, performance has been good certainly this year, but there have been ups and downs and different parts of the portfolio in that regard. When you look at other trusts or you look at the sector in general, though, you think of, or I think of private equity trusts and their discounts, which are very large. And sometimes I wonder whether those will change at all, whatever happens, because it's simply people don't seem prepared to be backing those or trusting the NAV even after realizations, that kind of thing. Would you ever get to a situation where you think, well, we need to scale back the private assets quite considerably more if we're going to get rid of this discount, or is it more complicated than that?
Well, I think through the sector, as we've seen over time, there is cyclicality as rates go up. So the discounts tend to widen in the sector, and they tend to come down when rates come down. So there's just a natural correlation there that takes place. But I think what we're seeing more recently is those realizations come through on private assets. But not everyone has been a beneficiary of realizations in the same way we have this year. Many firms are actually saying that realizations have been muted, particularly over the last 12 months. That's not been our experience. Year to date, we've had 175 million pounds of realizations in the first 6 months of the year, and we had a similar amount last year, and that's really because we were invested in the right themes that are playing out this year in terms of the IPO market and what's interesting from an M&A perspective. So we do believe just with the persistence and consistency of that coming through, and also to just enhance transparency around valuation processes. So our funds portfolio, as an example, is valued every quarter, and our direct investments are actually revalued every 6 months, and that's done by an entirely independent committee of our board. So I think it's just also too a matter of getting the messaging out around the valuations and then proving that out with a good track record of a steady stream of realizations, as we've been doing over the last 12 months.
Do you anticipate those realizations to continue at roughly the same pace? I mean, it's impossible to say to an extent, but is that what you're looking for in the next following quarters, that kind of thing?
It is impossible to say, but across the three themes where we've seen the strongest realizations in our private assets, so be that in fintech infrastructure, enterprise software, and also too in AI, we've actually continued to see those themes play out in the second half of the year. And just maybe for a little bit of context, we had within that, so we had Webull go public via in April, and it's a very popular zero commission trading platform in the US. And then we had two M&A events within our portfolio. So in a company called Zappo Bank, which was one of the world's first crypto storage banks, just making Bitcoin a lot more secure to access and much more accessible. And then also to another M&A or significant realization when Meta decided to buy 49% of a company called Scale AI that's very much focused on AI infrastructure. And we continue to see those themes play out. We also had large exposure in the enterprise services space to a cybersecurity company called Wiz, which was taken out by Google. And what we're seeing this year, and what's also very encouraging, is two avenues or two ways to get realization. So the IPO markets, but also M&A. And that was really post the election of the new administration in the US that was very focused on deregulation. And we had written in our shareholder letters that we did believe that this was going to be a catalyst for unlocking value. And we've been seeing that materialize, including post our interim results.
We'll talk about asset allocation in a bit more detail shortly, but I've got a couple more operational queries. First of all, firstly, just the final point maybe on the discount is with the buyback. Clearly, the Rothschild family still own a lot of shares as well. How cognizant are you of that if you were to keep doing buybacks of the liquidity issues, are there any liquidity issues in that regard that you'd be thinking, well, we can only buy back to a certain point because we want the free float to stay substantial? Are we in danger of getting near that point at any time soon, or is that going to be something that wouldn't happen for a while?
No, that wouldn't be something that would happen for several years to come. So it's not a particular constraint at this time. And I am definitely hoping and that we're not talking about discounts for the next couple of years from an RIT perspective.
Indeed. And on the question of dividends as well, because RIT pays a dividend, has a good dividend record. The yield is not the highest, but I think that's something nice that shareholders will enjoy, of course, regular income. That dividend is effectively paid out of capital because you don't have that many income-producing assets. Can you talk a bit about your thinking there and whether that's likely? I assume that's likely to continue given the strategy of the trust as a whole, but can you say a little bit more about that?
Sure. It's definitely likely to continue. We've had 10 years of consecutive dividend increases. Last year, we increased our dividend by 10% for our shareholders. There's always been an element of paying some portion of that out of our capital. In some years, it's a little bit more. In some years, it's less than that. But on a trust with the size of our assets, actually, it's a very small cash element that comes out of the portfolio. So it's definitely something we can continue to afford and continue to increase over time for our shareholders.
That makes sense. So on the private assets, let's return to them, talk about them first of all. That exposure has fallen a little bit in recent years, partly due to realizations, but that also implies money being redistributed elsewhere. Do you have a target for overall what kind of proportion of the portfolio you want that to be nowadays? I know you have some broad targets, but also, notwithstanding all that we've said about skepticism over private assets in general, do you foresee a time when that starts increasing again, perhaps going back up to the upper limit, which I think is about 40%, which is sort of over 10 percentage points above where it is right now?
So it is a broad range, and a couple of years ago, private assets were just slightly above 40%. We fundamentally believe that from an asset allocation perspective, having our private assets anywhere as 25% to a third of our NAV is the right portfolio allocation. And we're just under that today. So that's really the target that we're seeing. Because of the realizations that we have been seeing, we continue to see that coming down over the next couple of years, but it's very core to what we do. It's been a very strong driver of returns for us over the last 10 years. We've generated a 15% annualized return from our private investments, and over the last 5, that's been 19%. And then year to date, our direct investments generated a 30% return for investors. But from a portfolio allocation perspective, anywhere from about 25 to a third of net asset value is really what we're targeting.
And of those private assets, a lot of exposure comes through funds nowadays. You've always had a fairly decent private fund exposure, but I think there's more than 20 funds in the portfolio. There was at the half-year stage just in the private assets area. Of course, there are direct investments in private assets too. Can you say a bit about the thinking there and how that's changed and whether that will change in future in terms of looking more at direct investments or looking at investing with others through funds?
Yeah, it is a combination of a bit of timing. We've had probably about 45% of our directs portfolio that's been realized over the last 18 months. And our bar for new investments on the direct side remains very high. So as a result of that, our funds portfolio has not come down at the similar pace as our direct investments. So it will ebb and flow over time. But I would say it would be typically more in that 50-50, 60-40 range that we've had historically. But it really depends on the opportunity set. And where we've been really looking to reinvest is if our top 5 core fund partners are raising new funds, we will look to invest alongside them. They've been excellent partners. The fund returns are top quartile from our perspective, and then we get excellent co-investment opportunities. And then in terms of direct deals, as I said, the bar remains very high. But what are we looking for if we want to introduce a new company into our portfolio and something that will resonate with our shareholders? Because we want to give them access to the best companies in the world that they might not be able to get access to otherwise. So we're looking for category leaders, the real winners in their sector who have very strong moats, very strong cash flows, high margins. And one such company that met that criteria, which we introduced into our portfolio last year, was SpaceX.
Hmm. Of course, I think most listeners will be familiar with SpaceX, but it's certainly one of the highest profile private assets out there. Uh, can we talk a little bit about the limits, perhaps on individual positions there, if there are? I'm sure there are some limits because you have a variety of different private assets. Do you have a figure in mind that you wouldn't have an individual holding go above in terms of unlisted shares, things like that, or does it depend on the situation?
So we really do try to build a diversified portfolio. So let's say our top 5 funds represent 60% of our overall funds exposure. Now that's quite concentrated, but we also have to remember we've been investing in those multiple funds since inception. For someone like Thrive, we've been investing in their funds since 2010, 2011. So that comes across multiple funds. So what you're getting is very diversified portfolio. And then on the direct side, we typically haven't had a position that's really more than 2% of NAV. Obviously, there will be growth over time, but just philosophically for our shareholders, we don't want any one investment, be that in privates or in quoted equities necessarily, to be so concentrated that it influences all the other returns that are coming or offsets all the other returns that are coming from the portfolio, really to keep that principle of diversification and resilience.
What about the communication with the managers of the private funds or any funds you hold? Because I'm sure shareholders in RIT would have their own preference for how often they look at the portfolio, the fact sheets, and check the updates. How often are you, as a professional, speaking to other professionals? How often do you communicate with each one of these managers and say, what are you doing? What are your thoughts? And or maybe why has your thinking changed here? That kind of thing. Is it ad hoc, or do you have monthly, quarterly check-ins?
We have a combination of the two. If we see something really interesting that's happened in the portfolio, perhaps it's a new addition, or we have a question on an investment. We have very strong relationships with our fund managers. We actually take a very partnership driven approach to that. So from our perspective, we might wait 10 years before we've invested with one of our managers, just building on that relationship. So it's relatively easy for us to pick up the phone and have a conversation with them. So we will have the regular check-ins as part of our process, be that with some people on a monthly basis or a quarterly basis. But if we see something that's taken place in the portfolio where we have a question, we'll just immediately get on the phone with them or send them an email and say, "Hey, can we have a conversation?" And they'll typically respond right away.
That makes sense. We could talk about the question of how to value these assets and regular valuations. But personally speaking, I feel certainly in the IT, we've done that a lot over the past few years. So I'm going to move on in that regard and look at recent asset allocation changes or recent individual changes. We've spoken about some of the realizations over the year in the private assets part of the portfolio, but looking at the trust as a whole, can you say a little bit about what's changed over the course of certainly this year, but perhaps, if anything, since the summer, which is when there was the last big half-year report, in terms of what you've bought and sold, what you've been looking at, what you've maybe thought better of, something like
Yeah.
that?
No, so I think the bigger changes we have covered, which is the realization through the privates portfolio. And what we wrote about in our interim report, some of the longer term structural themes that we've been thinking about. So, be that a multipolar world, which is really what we were thinking about after the US elections last year, which is America's retrenchment from the rest of the world. And that's really focused other countries to think about their own energy security, their own infrastructure, and so on. So we have looked to increase our allocation to Europe and other places in the world. We also increased our allocation to China, and we view this just as a long term structural theme. And as a result of that, we've expressed that either through some direct investments, but we've also looked to increase our exposures to some of our specialist fund managers as well.
Looking at the quoted part of the portfolio, from what I could see at the start of this year, Microsoft has risen up there and has become a larger holding. On the other side of things, looking at UK shares, London Stock Exchange perhaps doesn't feature at all, or certainly is a much smaller position than it was. Can you say a bit about your views on both those companies?
So just with respect to both those companies, I mean, we really look to see where the best opportunities are and how we want to express our exposures. So we're clearly believers in the U.S. That remains core to our thesis, and we've also looked to increase our exposure to Europe, but specifically within, as I spoke about earlier, a multipolar world.
London Stock Exchange was interesting to me just because we've been looking at that recently. It's been derated since the summer, which I think was after it kind of disappeared, but it's been concerns about it being a victim of the AI narrative rather than, as it would hope, a winner from that. Is that something you consider with regard to the company itself, how its exposure to AI and competition, increased competition as a result of that could affect it?
No, not necessarily. It really means that we've seen other opportunities to express some of our long-term structural themes, and we've seen better risk-adjusted returns in other places in our portfolio. And as we run on a fully invested basis, we have to make some decisions around where we increase our exposures.
Well, we'll come back to AI, I'm sure, in a moment, because there's no avoiding it nowadays. On the subject of overall allocations, the other quote unquote other allocation bucket, which is currencies and liquidity, things like that, is up at about 7%, or it was at the end of August. Can you say a bit about what's in there and why that's crept up? Is that purely from a timing perspective? Is that due to currency exposures? Are you holding more liquidity to look to invest elsewhere? Are you cautious about markets? That kind of thing.
I would say the component of other is, as you said, it's more related to timing. So it could be a realization or cash that's come through, and then we've looked to redeploy it. We are not building a defensive cash position within our portfolio.
Mm,
We look to be fully invested for our shareholders. So it's just more a matter of portfolio construction and inflows and outflows and timing than anything else.
sure. And the other thing I wanted to talk about on the topic of general allocations is the fund. I may be pronouncing this incorrectly, but I'll defer to whatever your pronunciation may be in a moment. The Discerene fund, which is I think 4.5% of the portfolio, so a decent chunk. That, from what I can see, that strategy they have a decent amount in Alibaba, which again is in some ways increasingly seen as an AI play. Clearly, a big play in a lot of the Chinese internet story. Can you say a little bit about that fund and what you like about their strategy?
Yes, and actually, we had the founder in our offices yesterday.
Okay.
So, Discerene is a global value manager that was founded by Su Chen, and they're very much a contrarian investor. So when people are selling, they're in the market buying and capturing those market dislocations. And we've gotten to know Su Chen over the last 15 or 16 years. And about 5 or 6 years ago, when we decided we really wanted to bring in a very strong value manager into our portfolio, we invested in Su Chen's fund, and it's done exceptionally well for us over that period of time. We highlighted Discerene in our interim reports through one of our case studies. As of June 30th, they had generated a 14% return for us this year. And since we've put them in our portfolio, they've compounded at 21%. And it's also a reason through the compounding of returns how they've ended up in that 4-ish% range as part of our net asset value.
Are they largely China focused? I mean, as an outsider, it's hard sometimes to see what these funds are invested in. Is that their kind of main theme, or how are they structured?
No, it would really be because they saw value in Alibaba. They don't necessarily always disclose their holdings,
Sure.
but they're very much a global value investor. But they'll go where they see value and then look to own those companies with a very long term perspective. They could take a decade long view as to that holding. Su Chen is a big believer in following Warren Buffett's style of style of investing. And we've seen that China as a market, particularly in the earlier part of last year, was trading at very, very cheap multiples. Actually, we increased our China exposure as well, and we're seeing that play out this year.
Sure. Is this fund, it's maybe too dramatic to say increasingly an exception to the rule, but it does seem that the number of direct shares you hold in the quoted equity bucket is larger than it was versus the number of funds like this. Is that a conscious decision? Is that just the way opportunities are playing out? How do you see that balance
Uh,
between the two?
it is the way that opportunities are playing out. I would say in the second half of the year, we've really been looking to concentrate our portfolio further into our highest conviction ideas. But it will ebb and flow depending on how we're seeing the opportunity set and how we want to capture that, either through a specialist fund manager or to be able to express that idea directly. But we'll do that in the most efficient way for our shareholders.
Well, let's talk about the wider context of where we are right now. We're recording this right at the start of October. The question, which I don't think will be outdated no matter when we record this or when it goes out, is how do you feel about US tech valuations? Clearly, you have some or plenty of exposure there, as most people do nowadays. At the same time, there's a lot of uncertainty in the market, perhaps due to how far, well, not least due to how far these positions have run over the summer as well, and the AI boom, which we'll get to in a minute as well. But are you still, to put it in grand terms, perhaps a big believer in the AI transformation narrative in the whole US tech boom? Very much a believer that that's what's going to drive markets in future. How do you see the big questions like that?
So we do own very high quality U.S. names, either through our private portfolio or through our public portfolio. But I think to your question, what we're seeing is that really the big global market story is seeing the U.S. market is not the largest gainer around the world. We're seeing very strong equity market returns come from Europe or China or Japan. And this broadening out of the market is really where we see the opportunity set. We're also, and this is largely because there have been a lot of overlooked areas of the market for a long time now, as everyone's attention was on a very concentrated group of stocks. But we, having run a diversified portfolio, we've been benefiting from strong equity market gains outside of the U.S. in addition to our U.S. holdings.
Just to hone in on AI a bit more, because I can't help but do so, because you're right that the gains have been broadening out, certainly in the first half of this year. But because of the focus on these companies and because of, I think, arguably the way they still drive global markets, and if there were to be a reversal there, that could have a knock-on effect everywhere, as tends to be the case with the US. What are your thoughts on, say, recent AI activity? We've seen a lot of deals in the past few weeks, certainly involving NVIDIA and investing in OpenAI, and to an extent, vice versa. Some of these deals are becoming quite circular, and that's got people perhaps concerned about whether we're reaching a peak in valuations. I mean, people have been concerned about that for years now anyway, but some of these perhaps late stage deals, shall we say, have got some eyebrows being raised. So what's your view on, firstly, those? Secondly, on the question of what companies need to do to show that all this hope in the AI boom is justified? Are we at a point now where companies need to start showing results, productivity gains from AI? And I'm talking not just about the tech companies, but all companies who've been using this technology. So there are two distinct questions there, but I'm just interested to get your thoughts.
So I think what we've seen is that there is a lot of capital that's needed to create the infrastructure for AI adoption, and we're seeing a lot of those deals take place as you've announced, as you've noted. But I think the real story is actually the second component to your question, which is AI adoption and how that's going to impact equity valuations for everyone else. So I think for companies that have definitively said we've adopted AI and started to create guidance or estimates around the productivity gains that they've seen from that. I think here this is where the opportunity set lies, which is which companies are going to be able to adopt AI successfully and prove that out to the market. And those are going to be the the real winners. And how we think about that, I might use an example of a private company in our portfolio called Motive. They provide it's an AI platform that provides support to the logistics industry, so fleet,
Mhm.
trucking, and so on. And they look to take all the operational aspects of running that business and put it on their platform to make it more efficient. So what you see are cost savings, margin gains, and actually improved safety outcomes. And for those companies that are able to bring that platform and adopt it successfully, then they should be the ones that outperform. And you'll start to see that in financial services, in healthcare, and in industrial companies. But I really think it's to your point, it's the effectiveness of the adoption, and not everyone is going to be able to adopt at the same pace or successfully. And
Mm.
that's really what we're looking for.
Are you finding those companies, certainly in those areas a step removed, as you say, financial services, industrials, are you finding more of those companies evidence of that actually starting to work, or are we still at a very early stage of that process?
We're starting to see that. It is in the earlier stage of that process, but I think over the next couple of quarters, we're gonna see increased adoption of that because we can see that coming through some of our private companies and the growth that they're seeing, which will ultimately translate to their customers, many of which are publicly listed
Mhm.
companies.
Just this is less of a market question, but sometimes some people have been speaking about this as well. When you think of things like AI productivity, you think about improving productivity, getting rid of bottlenecks. But is there a risk with a lot of these things that you could create, without getting too philosophical about it, almost a bottleneck behind the bottleneck, whereby you can improve some parts of a workforce, make some part of the business much more productive? That only means that some non-AI person is then having to deal with a lot more queries, and there's an inevitable slowdown at some point of that funnel. Is that, how easy is that to discern as an investment manager looking for these opportunities, as to whether, because people could be using AI very effectively in one part of their business, but it wouldn't actually produce that kind of outcome. So how do you kind of guard against those kind of risks, perhaps?
So I think it's really trying to understand how if companies necessarily are still in the experimentation phase of
Mm,
of AI or truly adopting it and taking a very holistic approach. So if I go back to the example of Motive, if you're adopting that platform into your company, that's actually covering the full range of your operations, ensuring that success and those productivity gains. But there is an element of still experimentation that's taking place that doesn't necessarily drive the results that you're speaking to. And then there's the more holistic approach that companies are providing. So it's just a matter of looking for the right things.
let's move on. Let's talk about Europe, for example, one region which, as we've said, had a very good start to the year, a little bit more mixed, relatively speaking, at least in the past couple of months. But there are a lot of narratives there regarding, I think, as we've referred to already, the security and that side of things, but also perhaps some more optimism over the fiscal situation with Germany's big stimulus package earlier this year, and certainly a lot more investor interest too. Are you finding more opportunities in Europe as a result of these kind of trends? Or are you at a situation where you're thinking, well, the valuations were just so attractive that we had to look there for that reason? It's probably a bit of both, but can you say a bit about what interests you in Europe on the equity side?
It is a combination of two. European equities were trading very, very cheaply, and what we've seen is a very strong catalyst come through. And we really think about this as a very long-term structural trend in the market. So quarter by quarter, things might vary. But politically, what we can see is that Europe does need to invest in its own infrastructure, energy security, and its own defense. We're very early in that part of our thesis, so we see a lot of strong growth coming through. But that's going to take time.
And what about Asia as well? You say there's been more of the portfolio there. What kind of stories, investment opportunities are you seeing? I mean, it's a bit of a ridiculous question when you're talking about a giant continent, but maybe you could pick out some of the companies there that are particularly interesting to you at the moment.
Well, you have a lot of market leaders in China, very strong local champions who also fundamentally believe that their shares are trading at very cheap valuation. So many of these companies have also been buying back their own shares. We're also seeing very strong network effects through supply chain logistics in China. So we're seeing very, very strong opportunities there.
And on the UK, I should, of course, refer to our own market, which has had a pretty good year. There's still some attractive valuations. Is that the way you see it? Have you become more optimistic about UK equities over the past year? Maybe that's the way to phrase it.
So we don't necessarily think about geography within our portfolio to have a set allocation to the UK, Europe, China, and
Mm.
Japan from that
Notwithstanding my
perspective.
questions on all these
Yeah,
geographies, but yes, yeah.
but we really think about our long term structural trends and look to translate that back into where we see the most opportunities. So we continue to look for opportunities around the world, but no, we don't have a significant allocation to the UK today.
I'm going to return to AI maybe just as we approach the end of the show, because one thing I wanted to ask before was something that's almost been forgotten in amongst everything else that's happened this year, which was the deep seek emergence at the start of this year, where it turned out that, depending on how much you believe the narrative, but it turned out that the Chinese AI technology was able to do a lot of things seemingly much more cheaply than people had thought, and seemingly without access to certain US companies. That caused a little bit of a concern and a brief rethink, perhaps, of the AI narrative. But since then, it's been relatively plain sailing. I mean, as someone who's invested all over the world, I'm not saying you're going to be the person who spots the next deep seek, that kind of thing, but is that something that you're more cognizant of now, or are cognizant of in general, the possibility that there are these competitors out there who we may just not know about? Certainly, AI is clearly a uh, big part of the market now, but we see that in a lot of areas of the market in general, this kind of technology, suddenly these advances. You think about EVs as well over the past few years in China, where actually these companies have really been taking huge amounts of market share. How do you consider those known unknowns, shall we say?
So we do take the view that technology is going to evolve.
Mm.
So in general, so I'm not worried about the deep seek moment specifically. Really because of that. We assume that technology will evolve. Our job is really to find the best companies or the best management teams who are going to be leading that innovation. And we've identified those teams in the US. And as we've noted before, we also have exposure to China and other markets. And that's really the lens in which we view that.
What about the overall investment picture at the moment? Because we've alluded to, or certainly I've alluded to, perhaps being late cycle or having some late cycle feels. We've seen over the past few years some drawdowns, but they've been very brief. April this year being an obvious example, albeit there were catalysts for and against there. But how do you view, notwithstanding your position as a long-term investor, how do you view where we are in that process right now? Because markets are always going to have periods of drawdowns, bounce backs, that kind of thing. Do you think those risks are greater than they were 12, 24 months ago? How do you see that kind of process? These big questions that investors are constantly asking themselves, how do you relate that back to your portfolio and your thinking at the moment?
So, from our perspective, we actually think this is a very exciting time in the
Mm,
market,
mm.
really because global market returns have been broadening out, and we've been the beneficiaries of that between strong realizations and the right themes in the U.S., but also too what we're seeing in our portfolio across China, Japan, and Europe. And also to for some sectors that have been a little more challenged, like biotech, we're actually seeing that sector starting to perform in the second half of this year. So we actually think if you have a diversified and global portfolio like ours, this is the right market environment to be able to generate strong returns for shareholders.
Mm. On that subject, we've spoken about the end or a winnowing slightly of US exceptionalism and allocating elsewhere. And you do have in the portfolio, as you'd expect of a global manager, but perhaps a little bit more so, you have the currency hedging strategy to make sure that all these things, that you can take a view there, or perhaps all these things can even out. At the start of this year, with everything going on in the US, we saw quite a bit of dollar weakness. It's been a bit more mixed since then. But your view on currency, does it express that similar stance to what we've been talking about looking elsewhere and therefore maybe hedging against that kind of US risk a bit more? What's your view on that?
So we do look to our benchmark is partially in pounds, and we have half our portfolio invested in the U.S. So we actually look to hedge 50% of our U.S. dollar exposure. Just as a matter of course. We have not taken a specific currency bet within our portfolio, but we do look to hedge part of that for shareholders. Again, going back to ensuring that no one factor or investment within our portfolio is materially going to impact overall returns that are coming from the broader book.
That makes sense. Well, we have reached the end of our time, but thank you very much, Maggie. It's been a very interesting discussion. Thank you to you for listening. We'll be back next time with another IC Interviews podcast.